Most people over 65 believe the hardest financial decisions are behind them. The house is paid off, the career is over, the savings are set. But here's the uncomfortable question no one asks. If that's true, why do more Americans lose financial stability after 70 than at any other stage of life? That's the mystery. Because the biggest threats to your retirement money after 70 are market crashes, inflation headlines, or reckless spending. They're quieter, they look reasonable, and they're often encouraged by outdated advice that no longer fits how aging actually works. The early clues show up in small ways: a helpful phone call, a complicated document you don't feel like reading, a sense that you should trust people more now, a belief that stress is bad for your health, so it's better not to think about money too much. Something important is missing from that picture. To understand why protecting money after 70 requires different rules, we need to go back to where most financial habits are formed. In early adulthood, money decisions are driven by growth. You take risks because time is on your side. You trust systems. You assume mistakes can be corrected. Economists studying life cycle finance have shown that early financial behavior is built around recovery. Lose money at 30, you have decades to rebuild. This is the origin of the issue. In your 20s and 30s, financial optimism is rewarded. Markets rise over time, careers advance. Even bad decisions often fade into the background. But the brain doesn't automatically update its strategy as the body and timeline change. The changes start quietly in the 40s. Financial responsibility increases. You juggle family, housing, healthcare, and retirement planning. According to the Federal Reserve Survey of Consumer Finances, this is when most Americans reach peak complexity in their financial lives. Stress increases, but income still offsets mistakes, so habits form: delegating decisions, trusting authority, avoiding uncomfortable details. Then comes the shift after 70 that most people ignore. After 70, the financial game changes from growth to protection. Recovery time disappears, cognitive load increases. The National Institute on Aging notes that even healthy older adults experience slower information processing and higher decision fatigue. This doesn't mean incapacity, it means vulnerability. This is where the breaking point becomes visible. The first essential rule to protect your retirement money after 70 is this: complexity is no longer your friend. Financial products marketed to seniors are often more complex, not simpler. Reverse mortgages, annuities with riders, structured notes. They promise safety, but research shows complexity increases the risk of costly errors. The cause is subtle. Complexity feels professional, it feels protective. But studies on other financial exploitation show that confusion, not greed, is the most common entry point for loss. The effect is devastating. According to the Consumer Financial Protection Bureau, older Americans lose billions each year to financial mistakes and exploitation, often involving products they didn't fully understand. The second rule is equally uncomfortable: trust must become selective, not generous. Many seniors were raised to believe trust builds relationships. And socially, that's true. Financially, after 70, it can be dangerous. American banking and fraud data show that people over 70 are more likely to be targeted by scams that exploit politeness, authority, and urgency. These are not crude tricks, they are engineered psychological strategies. The hidden risk is emotional pressure. Scammers and even well-meaning acquaintances rely on the belief that being cautious is rude or paranoid. The benefit of selective trust is control. The third rule most seniors never hear is this: your biggest financial enemy after 70 is not spending, it's silence. ElderlyWisdom said, "Don't worry, you've earned peace, but silence creates blind spots." Studies show that seniors who stop actively reviewing accounts experience higher rates of unnoticed fees, automatic withdrawals, and gradual losses. This is not about micromanaging, it's about visibility. The fourth rule is the most emotionally charged: Mixing family and finances after 70 requires stricter boundaries than ever before. Family-related financial loss is one of the fastest-growing issues among older Americans. Loans that aren't repaid, shared accounts that drain quietly, guilt-based decisions that feel loving but create long-term instability. The cause often starts earlier in life, providing, supporting, sacrificing. After 70, the effect changes. The same behavior can undermine your own security. Now let's look at the fallout when these rules are ignored. Health declines first. Financial stress increases cortisol. The American Psychological Association reports that money stress in older adults correlates with poorer sleep, higher blood pressure, and increased hospitalization rates. Money follows quickly, small losses compound, fees accumulate, bad advice becomes irreversible, lifestyle shrinks. Seniors stop traveling, stop socializing, stop enjoying what they saved for. So what do people try instead? They try failed fixes based on old advice. They set it and forget it, assuming autopilot equals safety. They hand everything to one person and disengage completely. They avoid conversations to keep peace. None of these address the cause. Here's the truth revealed late. Protecting money after 70 is not about being aggressive. It's about being intentional. Strong data from American financial surveys show that seniors who simplify accounts, review regularly, and set clear boundaries experience significantly lower financial stress and loss. This pattern repeats across millions of older adults. Link this to today. We are living longer with more years exposed to financial risk. Longevity without protection turns savings into stress. So, what can you do today? Here are 3 direct actions people over 60 can apply right now. First action: simplify one financial area this month. One account, one product, one bill. Simplicity reduces error risk. Second action: schedule a regular money check-in, not too worrying, to see. Visibility is protection. Third action: put financial boundaries in writing. Even with family, clarity prevents conflict and loss. Here is the clear warning based on evidence. Financial decisions made under pressure after 70 are the most likely to cause irreversible damage. And here's the open thought to carry into the next video. What if the greatest gift you can give your family is not access to your money, but proof that you protected yourself? If this helped, tap like so more people see it. Share it with someone navigating retirement decisions. Drop a comment about the rule you wish you had known sooner. Subscribe for the next chapter, where we break down the most common financial traps targeting seniors right now, and how to avoid them before they ever reach you.